Hi, everybody, again, and a very good morning to you all. Thank you very much for joining us for today's K3 Hub CPD webinar. For those who don't know me, my name is Marie Wadeson, and I'm a Managing Director at Quantuma. And on behalf of our parent company, K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Our group offers a wide range of niche advisory services, which include restructuring, corporate finance, forensic accounting, R&D tax credits, and marketing services for professional services firms. Before I introduce you to today's speaker, I would just like to run through some housekeeping, as I ordinarily do. So as you will have noticed on joining the webinar, we are recording today's session. The webinar will be placed onto the K3 Hub and the Quantuma websites in the coming days. And you can also find our back catalogue of recordings in those places as well. So do feel free to go back and have a look next week. Q&A function is open for questions. We do ask that your questions are relevant to the course, and our speaker will do her very best to answer them. Preference is that you use Q&A for the Q&A function, to ask questions rather than in the chat, just so that we've got everything in one place for Karen, so that she knows where she's looking for the questions. We are going to put a copy of the slides in the chat, and I think there might be one going in very shortly if it's not already there. And we will periodically add them in throughout the course for those people who may join us a little later. We are aware that today's session is fairly long, and so we are going to take a couple of comfort breaks. They'll be there or thereabouts on the hour, and Karen will obviously signal those for you, so you can get a coffee or a tea. Right, okay, so on to today's webinar then. So I'm very pleased to be able to welcome back Karen Speight. Some of you who are regulars here at the K3 Hub will remember Karen, who has run some very popular sessions for us previously. I think it's fair to say that she's outdone herself today on this session, which I guess is not surprising given how topical today's subject matter is. A little bit about Karen, just for background for you. So Karen has more than 25 years experience working in professional services, both as a solicitor and a chartered tax advisor. She has her own business, providing education services for tax professionals, and she's also an author and co-author of a number of books published by Claritax Books. Karen's session today will broadly cover when IHT is chargeable, exemptions and reliefs, calculating IHT, administration and payment of IHT, and the impact of future changes. Just before I hand over to Karen and disappear off, just a quick word about some of the forthcoming K3 Hub events coming up. We have sessions on tax and AI, which I'm quite looking forward to. Commercial property taxes, which is always popular with our members. We've got employment, and we're going to bust employment law myths. We've got a tax update covering latest R&D tax reliefs and HMRC enquiry trends, and a marketing masterclass, which will be delivered by our sister company, JE Consulting. Invitations are sent out on a very regular basis, so do keep your eyes on your inbox. We also advertise the webinars on the K3 Hub and Quantuma websites and on LinkedIn. That's it for me today. So I hope you enjoyed today's session, and wishing you a great long bank holiday weekend. Karen, over to you.
Thank you very much, Marie. You set a high bar there, so I'm going to have to hopefully deliver on everybody's expectations today. So welcome to the session. Needs no thoughts about other than to say I am going to be looking at inheritance tax. This has been a subject that is really close to everybody's heart since the announcements in the autumn budget last year. Still not really worked out some of the changes because they are coming online over the next year or so. But whilst we've got this massive sort of debate going on. A lot of the focus has been on the budget changes and has brought really people to our door that we haven't otherwise seen, suddenly concerned about inheritance tax, believe that their inheritance tax position was sorted, but now we're faced with the the realization that that might not be the case, and they are seeking advice. So I thought, to me, what I'm going to do today with this session is really sort of take a step back from the sort of the specific points that people are being concerned about, and actually look at the fundamental principles of IHT and really work through the practicalities of when IHT arises and how we would go around doing the calculation, because we are having to start looking at things on a wider level and things that we've never even considered before, deciding whether they are relevant or not. I have had a number of questions in advance, and I will deal with all of those. But as I said, there's quite a lot to get through today, so we'll be available at the end as well. But please ask your questions. If I don't deal with it straight away, it's either because I haven't seen it or because I know I'm going to come on to it. But I promise you, I will have covered them all by the time the session finishes. So as I say, our agenda today, I think Marie really sort of summarised it, so I won't spend too long going through it. We're going to look at the basics. We're going to think about exemptions and reliefs. We're going to look at valuation, which is a key part of quantifying our liability, and then we're going to look at the calculation itself on lifetime and death transfers, and we're going to look then at administration of payment of IHT. Hopefully when we're looking at the lifetime transfers, we're also going to have consider the relevant property regime, which I know someone asked about, so we can specifically deal with that. When we've done all that, we're going to think about the impact of future changes because although they are the future, that is what's driving everybody to our doors at the moment. So I really want to finish off with that. So starting with the basics, let's remember what are we really thinking about? Well, inheritance tax potentially arises if we have a transfer of value of chargeable property by a chargeable person that is not exempt. And that relatively simple statement is a Pandora's box of complexity. Inheritance tax is, even though, it's been death duties, it's been capital transfer tax, it's been around for a few centuries, but it's only really been in its current form since 1984. And there's been bits of changes as we've gone along, and those have been bolt-ons rather than like a redraft. Even with the new rules that we have about qualifying new residents and long-term UK residents, as it's essentially a bolt-on rather than a fundamental rewrite. So it's a very complex tax. According to the Institute of Fiscal Studies, despite the changes, we still only have 4% of households who are affected by inheritance tax in reality. So, but usually the ones who are affected, their affairs are relatively complex. So with chargeable person is so in order to pay inheritance tax, you on your worldwide assets, you have to be a long-term UK resident. And if they are not a long-term UK resident, you're still subject fundamentally to inheritance tax, but it's on UK situs assets. So the proper definition is there. So when someone is not a long-term UK resident, they still pay inheritance tax, but it's excluded in respect of property that is situated outside the UK, a holding in an authorised unit trust, or a share in an open-ended investment company. For the property that is situated outside the UK, there's an exception to that exception. If its value derives from UK residential property, then it will not be excluded. So this stops us from putting UK residential property into an overseas wrapper, like a corporate entity based overseas, and then sort of saying, oh, well, our overseas asset are shares overseas, so actually that is excluded property. So it follows at a most basic level that if we are not long-term UK residents and we have overseas property that doesn't derive its value from UK residential property, then we escape IHT in respect of those assets. So that is like a fundamental sort of planning point. But it's the definition of long-term UK resident that we are dealing with at the moment. That's new from the 6th of April 2025. Residence is defined by reference to the statutory residence test in Finance Act 2013, Schedule 45. Now, that is a session in itself as to how to apply the residence test, and it's beyond the scope of what we are doing here. So I'm going to sort of be fairly glib and say that's how we determine residence. Interestingly enough, when we do look at the definition of long-term resident, we go back to the previous 20 tax years. So a long-term UK resident is someone who has been UK resident for at least 10 out of the preceding 20 tax years. Now, the Finance Act 2013 only came in from 2014, and therefore feasibly we are looking at years that are governed by the old case law. The exact reason why the Finance Act was brought in was to stop us having to rely on old case law. It's fairly subjective. Now, what I'm hoping in practice, it has been confirmed that for years before 2014, we rely on the old case law. So ironically, we may have a lot of you out there who've never dealt with the old case law and will now have to start looking at it because you're going back 20 years. And what we're hoping in practice is that everybody's position is settled where they are within where they were in past years. We know whether they were resident or not for those years for other tax purposes, but just something to be aware of when looking at residence. Now, in terms of points to know, if we've got this long-term UK resident, we've got someone for the 10 out of the preceding 20 years. Obviously, if you're below the age of 20, then you look at the residency for over half of their life. So if they spent more time as a UK resident than not, then they will be a long-term UK resident. If you're members of the Houses of Parliament or Lords, then you are, for as long as you are a member of those houses, you will be treated as being a long-term UK resident. Inheritance tax goes beyond the individuals. So a body corporate is a long-term UK resident if it's incorporated in the UK or if it's subject to corporation tax in the UK. So remember, if you can be in the net for corporation tax if your management and control is in the UK, even if you are incorporated outside of the UK. So if we've got an entity that is paying corporation tax, it will also be a long-term UK resident for our inheritance tax purposes. And I'll talk about how companies come into the mix later on in the session. Now, the thing that we need to be aware of is the tail, what we call the tail. So if we become a long-term UK resident, we continue to be treated as such, even if we cease to be UK resident, in fact. So where we are resident for less than 13 years or 13 years or less, our liability continues for 3 years. Once we get over 13 years, then we increase our tail by 1 extra year for each year of UK residence, with a maximum tail of 10 years. So yeah, if we've been a resident for 20 years in the UK, then we are going to be continue to be a long-term UK resident for the subsequent 10 years. So it's not the case that we can just say, oh, not long-term UK resident, let's get all our property overseas and let's move overseas. Remember, there will be this tail depending on how long we've been in the UK. Now, a split year counts as a full year for tax planning. So when we look at our years and we're counting them, we don't look at just like the calendar years or the actual time. If we've got a split year, that will count as a full year, which can bring us within the IHT net in full sooner than you might think. Okay, so it's chargeable property. We will have lots of examples, but I'll just getting through some of these basics first. Okay, we've got a chargeable property person, pretty much anybody except for this, but we've got this limitation where we're not a long-term UK resident. Our chargeable property, though, to be subject to IHT, our property has to form part of our estate. And the legislation is drafted in a really quite weird way here. Estate is defined as property to which a person is beneficially entitled to. So if we hold something, say, as a trustee or as a nominee, we're not beneficially entitled to it, so it doesn't form part of our estate. Now, specific things are excluded from the definition of the estate. The first one is non-qualifying interest in possession in settled property. And that's pretty much most interest in possession created after 2006, unless we've acquired them for money or money's worth. And then there's sort of certain minor and vulnerable persons trusts. Now, the impact of that is quite a complex definition. An interest in possession is simply something where I've got the right to the income. So I would have a trust up and it would say, I have the right or the enjoyment of this property for life. And then after I've died, it will go to someone else, the residuary beneficiary. So that's an interest in possession, but most of them will not qualify. Now, that doesn't mean it's outside of the scope of IHT. It just means it's not in our estate. As we'll come on to, all those non-qualifying interests in possession, unless they are like certain sort of death trust created on death for minors, will fall within the relevant property regime. So it's IHT in a different form. They just fall outside of our estate. Other things that fall outside of the estate is foreign-owned works of art that are situated in the UK for public display, cleaning and restoration. That just means that because we do IHT by reference to the location of property. If it's in the UK and you were not a long-term UK resident, you're subject to IHT on it. So this is just an exemption, effectively excludes it from an estate. So if we can loan a famous work of art to the National Gallery, and whilst it's on display in the in London, and if something happens to the owner, then that wouldn't fall within the inheritance tax net. And then finally, we have excluded property, which is why I said it's complex, because we say our property has to form part of our estate to have IHT. But in looking at the definition of estate, we have everything except excluded property. So it's quite convoluted. Now, excluded property is what we normally are focused on. It's okay talking about non-qualifying interest in possession, and it's okay talking about works of art that have been here for cleaning. The real that's suits and fits some people, but not very many. In real terms, we're interested in the excluded property, which is what we've decided, where we're not a long-term UK resident. We've already covered what is excluded there. And also, we've got to think about where that excluded property falls within trusts. So if we have a trust that consists of property that's situated outside the UK, unless its value derives from UK residential property, then that will also be outside will be excluded from for the purposes of IHT. Now, there's a big change around that, so some of you might be dealing with that with your clients, where it used to be that will be excluded where the settlor is not a long-term UK resident at the date of the chargeable transfer, and which could be the death. So it's different now. Sorry, I'll start that again. It used to be the case that trust property consisting of excluded property would look at the status of the settlor at the time the trust was made. So as long as you made your trust when you were not at that point non-UK domiciled was the terminology, it would always stay as excluded property, even if you subsequently became UK domiciled. Now it will all depends on the status of the settlor and sometimes the beneficiary, where we've got an interest in possession, when the date of the chargeable transfer. So you could go in and out of the IHT regime depending on your status at the time. So someone who was not a long-term UK resident when they set up their trust have excluded property, that's all great. But then if they subsequently become a long-term UK resident, then they fall within the IHT net. And there is no real sort of transitional provisions here. So, we might have, this will be one area which you are seeing where people are coming and they thought that it was excluded, their overseas property, it's in an excluded property trust, all of a sudden that no longer applies. Also excluded always is reversionary interest in trust unless we've bought them for money or money's worth. So in the example I gave earlier where I said, I'm interested in this property for life, and then when I die, it goes to someone else, the reversionary beneficiary, that it goes to someone else on the death of the life tenant is the reversionary interest. That never, if I have a reversionary interest in something, so I've got my mother living in a property until she dies and then it comes to me, that is not in my estate, that is excluded property. So if I was to die and have my own chargeable transfer, my reversionary interest in that would not fall within the estate. And then we've got certain decorations, medals and awards. So if it was like Order of the Garter or Victoria Cross, things like that, they are all excluded property as well. FOTRA securities, certain securities are only available to non-UK residents, and they are free of tax to those individuals. You'll know whether you've got one because it will be defined as that. That also doesn't come into the IHT estate. So we've always got to be mindful of this excluded property. It follows that if our assets can comprise of excluded property, then that is going to reduce our exposure to inheritance tax. And there's just put a slide there around the location of assets. Remembering if we are not a long-term UK resident, we are limited really to our UK assets. And therefore it's easy where we've got land because that's where it's physically situated. Tangible properties wherever it's located at the time, hence the exclusion for the works of art. Bank accounts are where the branch holding the account is situated. So just because you've got a bank account in Santander doesn't mean it's a Spanish asset. If you've opened it at your local branch, it will be a UK account. Shares and securities are typically where the register is kept. Interest in businesses and partnerships are where the business is carried on, as is goodwill. But I think quite interesting is the contractual debt, because that is where the debtor resides at the date of the chargeable transfer. So we've got essentially that is something that can be moved around. So we've talked about chargeable assets and chargeable people. We just really now need to focus on the transfer of value, because if we don't have a transfer of value, it doesn't matter. And a transfer of value occurs when our transferor's assets are reduced. And so this would be typically a gift or a sale at an undervalue. So if our estate doesn't go down in value, we've not had a transfer. Some transfers are deemed to be transfers of value. So, on death, we don't actually reduce our assets, but that is deemed to be a transfer of value of our entire estate. If we lose or dispose of a qualifying interest in possession in settled property, then that is also a deemed transfer of value. And certain transfers by a close company can be deemed transfer of values and track back to our participators. So this is quite a big area. I'm not going to do it in full detail in this session. It's almost worthy of a session itself, but it's something that we worry about if we are advisors to closed companies. Because if closed companies make transfers of value, so they transfer something to at an undervalue, maybe to one of the shareholders, maybe do something like set up a qualifying employee ownership trust. They're quite trendy at the moment, but we actually transfer things out to and we are not doing it at full value. That transfer of value can be tracked back and attributed to our participating shareholders, which we might not anticipate. So as advisors, we just have to deal with that. And there's lots of exceptions to that, where, so for example, if we're genuinely setting up an employee benefit trust, that would be, there are exemptions in the Inheritance Tax Act, but it is something we need to be aware of. We might get caught out. We might have a transfer of value in those circumstances. Also, if we've done a gift with a reservation of benefit, so we give it away but we keep some benefit in it ourselves, as we'll see later on in the session, that comes within our estate for inheritance tax purposes. At the point if we cease that benefit, then that will be a transfer of value at the point our reservation of benefit ceases. So we give our house away but continue to live in it. If we move out of the house at some point, say into care, the reservation of benefit would cease at that point. That would be a transfer of value at that point. And certain discharges and reductions of debt can also be transfers of value. Now, whilst we deem some transfers to be transfers of value, others are ignored. And the biggest one that we ignore is our disposition without gratuitous intent. So this is our bad bargain. So just because something is worth £100, say, but I let someone have it for £40 because I've put it on eBay, if anybody still uses that, or it's on Vinted, or it's it's the only way I can get rid of it. There's no gratuitous intent there. We've just done a bad bargain. That is not a transfer of value, and inheritance tax is totally irrelevant there. So just bear that in mind. Sometimes I've seen people sort of discussing inheritance tax and you think, no, this is an arm's length deal, just a bad one. Dispositions made for the maintenance of the transferor's family. You have to be really careful with this because this is where we actually give things away for regular maintenance. It's typically our children. So if we were to pay, say, our children's school fees, that would be okay if it was sort of dependents. The one that doesn't fall within this is if we pay the school fees for grandchildren. So they're not our immediate family. They don't fall within this. So we see a lot of grandparents who are paying their grandchildren's school fees. That is a transfer of value. It might be exempt under something else. We might be able to rely on, say, the annual exemption, which I will come on to, but it is not a disposition for maintenance. If we waive dividends or rights to remuneration, that's fine. We ignore that. And as I said, I've put there the main exemption for dispositions by closed companies. They are ignored. It's not an exemption. We ignore it. It's not a transfer of value. And also, which is quite useful, and I will come back to this as a tax planning point, is variations of disposition of an estate after death. So if we change our entitlement under the will to make it more tax effective, for example, then that isn't a transfer of value. So far we've seen this definition of estate, definition of excluded property. We've said we've got to have a transfer of value. Transfers of value are things that reduce the value of our estate, but some are deemed, we have extra deemed transfer of values, and then we have some transfers of value that we ignore. So we have to go through all that to get to that point. Assuming that we've got to that point where we have a chargeable person, we've got chargeable property, and we've done a transfer of value that we cannot ignore, we then start thinking about whether there is any inheritance tax liability. And before we sort of, or whether there's any exemptions. So our main concept that we rely on is the nil rate band. Now, this isn't an exemption. It's just a simply, after any exemptions and reliefs, we charge anything that's left at the rate of 0%. So when we're doing it, we always do the nil rate band comes after the exemptions and reliefs. I'm talking about it beforehand because it's the thing in practice that actually prevents IHT arising in the vast majority of circumstances. So even if we have a chargeable transfer of value after all our exemptions and reliefs, we attract the IHT at 0%. And to the extent they fall in the nil rate band. The standard nil rate band is 325,000, and this applies to individuals. So all individuals have this nil rate band. But there's also a number of additional nil rate bands. Now, these additional nil rate bands only apply to the death estate transfer, which we will come on to. And we have a residence nil rate band, which is currently £175,000. That applies to pretty much where we leave our residence or funds representing our former residence or to a chargeable beneficiary. We'll come on to a bit more about that later. We then have effectively two transferable amounts. Where our nil rate band is not used up when we die, we can pass that on to our surviving spouse or civil partner. We also have, if we have a residence nil rate band that we don't use, we can also bring that forward and it can be passed on to a surviving spouse or civil partner. And this is why the government glibly say that you don't pay inheritance tax on estates that are worth £1 million, because they're assuming that we leave everything to our spouse or civil partner, which is, as we will see, is totally exempt. And then that surviving spouse has two nil rate bands and two residence nil rate bands to use up, which in its total comes to I say £1 million. Let me just have a check there. I'm thinking I've got a question, so just bear with me. So yeah, so I'll come back to that when we talk about the residence nil rate band and who can get it or not. So I've noted that question, and I will come back. I will deal with it when we come back to the death estate. But it's a good question and a good point. But just bank that at the moment, as we've got these nil rate bands kicking about, some on death, but the 325,000, our own personal allowance, is always available to us. And this brings us to really the key of the inheritance tax, this idea of the cumulation concept. So inheritance tax is a cumulative tax, so that the amount of tax that's due at any one time depends on the frequency, the value and the timing of the chargeable transfers that have been made. So we always look, whenever we make a chargeable transfer, we always look to our other chargeable transfers in the previous 7 years and work out how much of our nil rate band is left. So if we've not done anything in the previous 7 years, then we've got 325,000 to play with. If we have done something within the previous 7 years, we will count it, and it reduces our nil rate band. It might reduce it to nothing, and we would therefore get into the next rate of tax. This 7-year cycle means that if we give something away and as we will see, there is no inheritance tax, we survive for 7 years, chances are it's free of inheritance tax forever. And you'll see when we've brought in the limitations on the when we come on to business property relief and agricultural property relief, and how we've now got this 1 million allowance from next year, that also renews every 7 years. at the moment. It's going under consultation, but that is the intention. So this 7-year cycle is incredibly useful for our planning, and we'll see that. So let's have a look at how this cumulation concept works, because we really need to, this is it. This is the heart of inheritance tax. So if we get this, we can do the calculations. So we've got Kay who makes several chargeable lifetime transfers before her death. We'll talk about what those are shortly. We can see there are 3. One in 2018, one in 2019, and one in a few months before her death in 2025. The first one, we always look at everything in chronological order, starting with the earliest first. So we'll go back, we look at those, and we think, yes, on her death on the 30th of August 2025, that is a deemed transfer of value. We look back 7 years. We can see all of those fall within the preceding. Do they all fall in the preceding 7 years? No. We would ignore CLT1. But when we make the transfers, we look at each one and we'll say, right, chargeable lifetime transfer in 2018 is taxed at 0%. Because even though it's chargeable, it's covered by the 325,000, and there's been no reduction of that because there's been no chargeable lifetime transfers in the 7 years before that. When we go on to the chargeable lifetime transfer 2, we look back 7 years, and yes, there has been a transfer. There was one in February 2018, but it was only 130,000. So we still got some of our nil rate band left, and that covers the 40,000 in full. So we've no tax again. And then on the 7th of April 2025, we see, yeah, it's 250,000. But if we look back to the preceding 7 years, we're going to be ignoring the first transfer. So we only had 40,000 transferred in the preceding 7 years. So we've still got our 325,000. We've still got 285,000 left. So all of those, even though these transfers have been made, at that point when they were made, none of them attracted inheritance tax because they all fell within this nil rate band, even though they add up in themselves to more than 325,000, because we only look back 7 years and it essentially is cumulative over that period, they fall out. So we can use that concept really to help us with our planning. Those are lifetime transfers, and we'll come back to the impact of the death on those lifetime transfers shortly. Just want to talk a little bit now more about the residential nil rate band. So, as we said, the key thing is the main residence or its replacement, or it's if we've sold it and moved into care and we've just got cash, then an amount representing that is available where it's left to a direct descendant. So it's not for a spouse, it is a descendant. So it's really our children or our grandchildren. It's available only on death, and it is for 175,000, or if the house is less than that, taking into account any outstanding mortgage, then it is restricted. In real terms, when this was brought in, it was intended, I think 2017, it was intended that it would be increased by inflation each year, but that's not happened. It's been frozen and will continue to be frozen for the foreseeable future. So it's not, it's not a huge amount of value. It's also tapered if the net value of the death estate exceeds 2 million by £1 of the resident nil rate band for every £2 of excess. So again, if we have 2.35 million on our net estate, then that is going to not be available to us. Obviously, if we don't leave anything to a direct descendant, we leave it all to, say, our spouse, we would be covered by the spousal exemption. So we don't need it. and that therefore allows us to pass that on to one of our to our spouse or civil partner when they die. So the net value, as we say, when we're looking at this 2 million, the net value is the value of the estate after our liabilities, but before our exemptions and the nil rate band. But if we've got a huge estate, then it's not nowhere near as useful this as it might sound. But if we do have, it is good, because if we are the second spouse to die, second civil partner to die, or we have the opportunity to leave our residence and sort of skip our spouse, if we're the first to die, then we've got effectively this 175,000 nil rate band where it's taxed at 0%. As I say, it doesn't really deal with that. So if we have the again, sorry, let me just check on the questions. Yeah. So yes, I think the slides will be made available to you shortly. So as we said already, if we actually leave everything to our spouse or civil partner, it's going to be exempt. So we've wasted everything. So we're allowed to use them on the second spouse or civil partner can use those. There's lots of detail around that, which is probably beyond the scope of what we are doing today. Only on the death transfer, and you do need to make a claim, or the personal representatives do need to make the claim for that. Okay, now it does use a percentage rather than an actual amount, so it does accommodate changes in the nil rate band. The nil rate band's been the same for ages, but if we were to, so say I was to die and leave everything to my spouse today, the nil rate band would be 325,000, but I would use a percentage. None of it would have been used. So I've got a percentage is 100%. Then on the death of the second spouse, they get 100% of whatever the nil rate band is at the time. So if the nil rate band goes up, the unused spousal rate band also increases because it's done by a percentage rather than an amount. Okay, so that's the spell. I'm just thinking in terms of your question then, we would, because we leave it to a spouse, then they would not be, it doesn't come into point where we've got the residence nil rate band. However, the second spouse is able to utilise it for them if they leave a UK residential property to a direct descendant. In real practical terms, I talk to people, this is just not that useful in practice because you don't really want to leave your main residence to your to your kids if you've got a spouse living in it. It's not ideal. Might be useful if you've got where you are the second spouse or civil partner, but it's of limited value because of the amount that's attributable to it. Okay, so we've talked about transfers of value. We've talked about deemed transfers of value. But some of them are totally exempt. And it's this where we need to really play in terms of our planning. So we have some transfers that are exempt in life and some that are only available on death. Some that are available on both. So our life only ones are very useful in that we can use those whilst we are well to essentially reduce the value of our estate that we do not need. So always remember that when we are giving things away, practically we need to leave ourselves with enough to live on. So we don't want to get carried away in practice with, we can do things for tax purposes and say, you know, give an amount away each year, but unless we can actually afford it, then we are, you know, it's not really advisable. But if we can afford it, then we can make use of these life transfers. So the life transfers, we've got an annual exemption of £3,000. We can only carry that forward 1 year. So if we didn't use it last year, we've got £6,000. Small gifts of £250 or less to the same person in any one tax year. So we can give multiple gifts of £250 or less to different people through the year. We can give gifts on marriage, which is 1,000 to 500, sorry, 1,000 to £5,000, depending on the relationship that you have to the couple. So if you're a parent, you can give £5,000 on marriage, and it's exempt. It's to each person rather than to the couple. So you could actually give 10,000, and if you are married, the mother could give, well, you don't have to be married, but the mother could give effectively 5,000 to each of the couple, each person in the couple, and the father could as well. So £20,000 could be passed down. So that's quite a good exemption to use on marriage. Includes it if you're paying for the wedding as well. That's also like comes out of it though. Normal expenditure out of income is incredibly useful. So this is where we give things and we pay for stuff. This might cover the fees for the grandchildren, because we just actually spending our money. The thing about that is it has to be normal, which means that we would have it more than once. You know, normal means it has some kind of regularity around it, and it has to be out of income. So we kind of have to show that we've got enough income coming in to cover our normal expenditure. So if we said, well, the fees for the grandchildren, if I did it every year, fine, as long as the expenditure was coming out of income. It doesn't have to be directly from that account, from that income. We could pay it from savings, but I have to show that those savings are being replenished. So if I've retired and I'm using my savings to pay for my grandchildren's school fees, that's going to not be normal expenditure out of income. So something just to watch. Is it affordable? Now, also on life, we've talked about the transfer of to spouses and civil partners. Just bear in mind that this is limited where the recipient is not a long-term UK resident. So to stop long-term UK residents passing things out to overseas properties, for example, to long-term non-UK residents, and bringing that out of the IHT net, it's limited. So when my transfers to spouses or civil partners where the recipient is not a long-term UK resident is capped out at 325,000. That's actually not per spouse, that's per transfers to non-long-term UK resident spouses. So if I have two in succession, then I don't get two 325,000. I just have one. We can elect as a non-long-term UK resident spouse to be treated as long-term UK resident, but that's for all purposes. So, you know, you wouldn't necessarily do that unless you had to, but just bear that in mind that where you've got one who is UK resident and one who isn't, then we have that limitation. Gifts to UK charities and sporting clubs. It's now limited to UK charities. Used to be EU charities, but since Brexit, they did update the legislation last year. So those are totally exempt. I know there's some sort of schemes and arrangements out there where people are creating charitable trusts to take it outside of the estate. It's a question of fact as to whether it is a charity or not, and you could really do with recognition by HMRC that is a UK charity in order for it to work properly and be comfortable that it's working properly. Gifts to qualifying political parties have to be real, don't have to be in government, but they do have to have at least usually one MP. So we can't just make a political party up. And we've, of course, got business property and agricultural property relief, which are worth their own. Well, let's dwell on them a little bit more. On death only, we've got certain, if armed forces or emergency service personnel are killed in the line of duty, that would exempt them from IHT. And there are certain payments that are received to World War II victims and victims of Japanese POW camps that are exempt. But to be honest, in real terms, on death, we're really looking at the spousal transfers gifts to charity and business property relief and agricultural property relief. Those are the ones that give us the most value. Not dealt there is like woodland relief, which is linked in to the agricultural property relief, is quite bespoke. So what is an example there? Just looking at our time, we've got the Malia. She has 140,000 a year in earnings, so that would be where I'd be thinking about that in terms of my normal expenditure out of income. And over a few years, she makes various transfers from the Conservative Party to a son on his birthday each year, to a daughter on marriage, school fees for a son, presents to friends, sapphire rings to a daughter as well on her birthday. And literally, this is what we have to do. We need a list from our clients of what they give and when, and then we can go through those. And in real terms, there's nothing, the only thing that worries me there, or doesn't worry me, will be is the gift to the daughter, because that on her marriage, because that is only exempt up to 5,000. So the 10,000, as we will see, would be a potentially exempt transfer. There'd be no tax if she survived for 7 years. And the sapphire ring is not exempt at all. It's just a one-off. Whereas the gift to the son every year, it's a normal gift out of income because he gets it every year. So again, if you're going to be using the normal gift out of income for your children's presents, then you're best passing it down on a regular basis. So I know a number of would be former clients who give every grandchild, £2,000 for Christmas every year. That's normal gift out of income. And it's because it's done every year, we can use that exemption. Small gifts, all fine. It's not a huge amount. The thing about small gifts to really watch is that it is £250. So if you give someone £251, it's not exempt. It's not just that you say, oh, there's £1 excess. Unlike the gift of marriage, you can give more. It's just the excess that is a transfer of value. For the small gifts one, it is 251 spoils it altogether. Okay, so there's some considerations there. I've mentioned the small gift exemption, that's all or nothing. We've talked about normal expenditure out of income, but really in terms of how we deal with these, we should always use our specific exemptions first and save our annual exemption only if no other exemptions available. So for example, you've got, most people say, oh, it'll be covered by the 3,000. Let's not do that. Let's try and articulate specific exemptions, because if we were to, we might need that annual exemption for something else. When we do look at the annual exemption, we always apply it in strict chronological order. So this might not give us the best tax result. So I've just got a couple of questions there. Let me just have a look at them. Yeah, so Ted, I can deal with that quickly. No, so capital gains don't count as income, they're capital. Your interest that you would get on your capital gain if you invested it, that would be income. So yes, this is a very good point. If you were to sell a property, say, make a gain and decide to give that to your children, that would not be normal expenditure out of income. It might be covered by some of the other exemptions, but wouldn't necessarily be covered by that one. In terms of records, yes, so detailed records have to be kept. You need to be able to justify it. So in terms of, we saw that previous slide, what you really want is that kind of slide for your client where they put the date, what they've done, and who the name is. We'll come on to the valuation shortly because it does, as you've rightly said in your question, it comes down to valuation, but that's what we need, information around it all. And it's really difficult to construct one of these. When you come to something that you think tax is actually due on, it's actually quite hard to reconstruct from nothing. So anybody who's potentially in inheritance tax should keep the records as they go along. The Going to this chronological point, though, the annual exemption's always applied in strict chronological order, even if it's not the best tax result. So we'll come on shortly to seeing that some of our lifetime gifts will either be immediately chargeable, subject to the nil rate band, or will be potentially exempt if they're not exempt altogether. If we make a potentially exempt transfer in the same tax year before the chargeable one, our annual exemption will be set off against that potentially exempt transfer. As we'll see, if people survive for 7 years, there's no tax. We've effectively wasted it. What we could have really done with was the annual exemption being set off against our chargeable, immediately chargeable transfer. But if that's made later in the year, that can be problematic. So somebody should also, so people shouldn't just keep detailed records of the gifts that they have made and their exemptions that they've used and the values, but they should also, where they are planning to make multiple gifts, they should think about the order. Now, in real terms, as we will see, we usually know a chargeable lifetime transfer is usually involved in a trust, so it's usually a big deal. We usually know quite a bit about it in terms of the planning. So we're going to be choosing to do that before any pets that we do. So business property relief, this is the one that everybody's sort of thinking about. It is going to change. At the moment, it's always applied before the annual exemption. And in order to claim business property relief, we do need both a qualifying asset and a sufficient period of ownership. This is qualifying assets pretty much if we've got our own business or we've got a share in a partnership or we have shares in an unlisted trading company or we've got a controlling interest even in securities, so shares in an unlisted trading company or a controlling interest in securities. Securities is wider than shares and would include, for example, loan notes. Then all that is at 100%. It's the aim that is controversial at the moment because the AIM listed trading company it currently gets 100%. From 6th of April 2026, it will go down to 50%. So you won't necessarily, that could affect you. Other ones that attract 50% is a controlling interest in securities in a listed company and land, buildings, plant and machinery that we own, but we use it in our partnership or in a company in which we have control. Now, we can see, therefore, that if we have an interest in shares or securities in a listed company, so one on the London Stock Exchange, for example, and it's not a controlling interest, there's no business property relief. And that makes sense because that's not, we're not really our business. Everybody, that would be typically an investment, would be lots of people have share portfolios. That doesn't give you the right to business property relief. We also have to, so we're really looking at where we have the business, so we have a controlling interest in it. The qualifying assets also have to have been owned for a minimum of 2 years prior to the chargeable transfer. So that could be our death, it could be us giving it away. There's some things to think about with our qualifying assets, though. It needs to be a trading company. Now, a trading company is quite a generous definition here because it means that it's not wholly or mainly carrying on investment activities. So we can carry on quite a lot of investment activities. We might be used to seeing when we're looking at trading companies for other definitions where 20% of investment activity causes us a problem. But really, we're looking here because of the definition, we could have up to 50% of investment activities and we would still qualify. However, where we do have investment assets, our BPR is scaled down. So we might not be excluded from business property relief, but we won't get business property relief for our non-business assets. So we can't really, if we can't shelter no investment assets in our trading company. We might, if we're not careful, we lose BPR altogether. But even if we don't lose it, we do. Our BPR is scaled down. Watch for huge cash surpluses here, because if we've got a business asset, cash or property that we've not used for the last 2 years in the business and they're not required for the future running of the business, then that would count as a non-business asset and the BPR would be scaled down and would exclude it. So if we're actually sat on a lot of surplus cash, we might find that that cash in itself isn't subject to BPR. Again, it's to stop us holding cash in our and pretending or treating it as a business asset. When we're looking at whether we've got a controlling interest, we do look at the related property, so property held by our spouses. And if we have a pre-existing sale contract, then our property is excluded as well. So be aware that if somebody dies between like a contract and completion, then that could be, that would exclude us from BPR. You need to be really careful about certain put and call options and whether that is effectively amounts to a pre-existing sale contract. Okay, so I've got a few questions there. Okay, if you could, so Parry, you've asked a question about someone who gets state pension, making normal expenditure out of income. If she has unused income, then that's fine, as long as she's got a surplus. It'd be interesting to see if she had income from the past. So if I have income from last year and I now make I'm using it, it's going to be normal expenditure, then that should be all right. It's going to depend on the level. So you might on that. But potentially, yes, she's got a state pension level to do it. You don't have to show what you spend on your, sorry, I'll say it again. You don't have to prove your outgoings. You just have to make it reasonable that it's part of your expenditure. It is part of your outgoings, is what you're trying to show. Oh, let me have a look. And yeah, so Naresh, I'll come back to that. It's all about abuse. So Neil is saying if we've got surplus cash and we've accumulated it from the thing and now we want to give it away, it's a question of degree, because you could always say that any sort of gain that you've had at the from the past is like money you've saved and therefore it's income. So if it's not abused, HMRC don't take the point, but you do have to be a little bit careful because they do want it does need to effectively have income to cover it. So when I said the relief is scaled back, Alfonso, what I mean is that if you had, say, 40% business assets, and 40% non-business assets and 60% business assets, you still get BPR because it's not wholly or mainly carrying on investment activities, but you would only get BPR on 60% of the value. So that's what I mean by it being scaled back. So yeah, so if you have a trading company that owns commercial property that's rented to another business, that's an investment activity. So again, it depends on the scale of it. That would be a non business asset. Yeah. Yeah, Alex, it's a really good question. Is that so a lot of people are asking about this thing around at what point does income become capital? And do we, can we take income from previous years and say that that is our normal expenditure? I'll get you chapter and verse on that over the break. As I say, it's a question of fact and degree. It's just a point of challenge by HMRC, so it's an ability for them to deny it. But I'll get you the references for that during the break. Okay. So let's have a look at example. This might help us out a little bit, and then we'll have a break. So we've got Josie as 100% shareholding in KLS Limited. They manufacture water coolers. She makes a chargeable transfer of her shares, and at the time they're worth 400,000. She's always used her IHT annual exemption, so that is not in point here. We've got net assets of 2 million. Included in those assets is £100,000 cash and surplus office accommodation that is worth £300,000, which is currently let out to a third party. Now, it would normally be 100% because it's not wholly or mainly consisting of investment activities, but it is going to be scaled down here to reflect the 300,000 that is currently let out to a third party. So that essentially BPI would be normally 100%, but it's going and would attach to the 400,000, but it's now only attaching to 340,000. So the gross chargeable transfer here would be £60,000. Now the cash isn't included here but it would be if it was like really surplus to the business. And it's just a point of proof here. There's no set thing about when the HMRC say no, this cash is surplus to the business. As long as you can say no, it's not, because we have these working capital requirements, we always need 100,000, then they're not going to query it. It's really designed to stop people who stash millions in and say, yes, we need this for the business. But if you've got something that's business, you're going to be buying a factory, you've got new machinery, it's not a cash surplus there. Okay, and just a few bits of consideration about the ownership. As I say, I want to finish BPR before we have our break. I know there's lots of questions. I'll look and check that we've done that whilst the break and that I've covered them off. So business property, if it's acquired on the death of the spouse or civil partner, you can include the period of ownership of the deceased spouse or civil partner. So, I inherit my husband's business, but I can't be doing with it. So like 6 months down the line, I carry it on for 6 months, but I decide to sell it. I can amalgamate my husband's period of ownership when I'm looking at whether I've had it for the 2 years or not. If we sell our business and then replace it, then that's fine, as long as it's we have a combined period of ownership of 2 years out of the preceding 5. So that can be really useful. We don't have to replace it with the same business property either. So we don't have to sell a controlling shareholding and then buy a controlling shareholding. As long as it falls within the definition. And if we have a second transfer on the ownership period on a second transfer of the business property, if the first transfer qualified for BPR and one of the transfers is death, then it's deemed to be satisfied. So we don't really have to think about it where we have sales and deaths and sales very sort of quickly. Okay, and on death, just finally, so BPR, we sell, we give away our business in circumstances or sell it at an undervalue and it's not at arm's length, we would say, yes, it qualifies for BPR. What we will see is that after the break, we'll see that when someone dies, we have to revisit any of our lifetime transfers within the preceding 7 years. So if we've relied on business property relief being available at the time somebody makes a transfer and then someone subsequently dies within 7 years of making the transfer, the question comes as to whether BPR has still been available for that earlier transfer. And it is, as long as the transferee is still using the asset as a business asset at the date of the transferor's death, or their own death if earlier, or they have disposed of the asset and reinvested it in qualifying replacement property. This additional condition gives us problems where we decide that we are going to give our property, our business, whilst we are alive, to put it out of our estate, and we're going to rely on business property relief, and we don't survive for 7 years. And in the meantime, the person we've given it to has decided to sell it and then spend it on holidays or fast cars, unless that's your business. Then we will, when we revisit it, we won't get that business property relief on our earlier transfer. We will see that in operation in an example. Okay, before we do agricultural property relief, I want to take a 10-minute break there because I really want to look at the questions and make sure that I come back to them. So 10 minutes and then we will start again. Thank you very much. So welcome back. We are there. So I have put in the chat box a reference to HMRC's guidance about this income and capital issue. You'll see from that, and why I was being so vague about it is that it is a question of fact. So you'll see from that guidance and that reference that it very much depends on whether you've got income and how long you've had that income for. Typically, HMRC say that if you've had income accumulated for more than 2 years, then it's starting to take on the nature of capital, but that might be sooner or it might be longer, depending on the actual facts. But it does say that it is quite common for people to say, this is really my income, I've just accumulated it over years. They won't allow it for that. So I think that answers quite a few of the questions. Some of the other questions were very specific about business property relief, and I'll come back to that at the end if I've got time. So I've not forgotten you if I've not dealt with it. I just want to push on and get through this, and we'll talk about client scenarios at the end if we've got chance. So agricultural property relief, it works very similarly to business property relief, and it applies to land that we use to grow crops or rear animals, farm buildings, as well as transfers of controlling interest in farming companies. If the relief is going to be 100% if the transferor or an unlisted company controlled by them has the current right to vacant possession of the lands of the buildings, or it was let out on a tenancy that commenced on or after 1995. So most tenancies, in reality, we get a business property relief of 100%. In other cases where it's an older tenancy or where your controlling interest is in a listed company, then your relief is 50%. Or if you do, indeed, if you don't have a controlling interest, if it's for land, buildings or plant and machinery used in a farming business that's run by your partnership or a company under the transferor's control, then it's 50%. Now that is really a summary. So what amounts to farmland, what you do where you've got people who are living in a farmhouse but they're not using it for the farm business, what we mean by land and building being used in the farming business, all those are very detailed questions that would get a session in itself. So probably not usually helping in terms of this summary if you've got a client who's got agricultural property relief, but it is really a matter of finding out what your property is and making sure it fits the definitions, and then looking at the ownership. As we said, if in order to have a qualifying property for agricultural property relief, not only does it have to be a qualifying asset, but we have to have a period of ownership that's very similar to BPR, where we own and occupy the land, then it's 2 years out of the preceding 5 years. If we've got replacement property, that's okay. Also, if it's occupied by someone else, then that is it's a longer period of ownership. It's 7 years before the transfer or 7 years out of the last 10 years preceding the transfer if it's replacement property. So again, if I've got a tenant who farms my land, I can have agricultural property relief. Depending on the structure, that can be 100%, but I will have had to have had that for at least 7 years. So we do, it's quite a long time. So with this idea of let's buy some farmland and rent it out to a farmer, that's all good for agricultural property relief, but we do need to have it for a longer period of time. And we've got similar provisions to the business property relief that we talked about in terms of successive transfers, replacement property, etc. I think people know whether they have got business clients with business property relief or with agricultural property relief. The big question that's facing everybody in practice is like, do they still have it after April 2026? And if they don't have it in full, what does that now mean? Because the big impact of the changes we'll see is that we get in this 1 million allowance at the 100%. So if you've got 100% relief at the moment, it'll be capped out at 1 million. Combined agricultural property and business property, and that is a 7-year rolling amount and a rolling allowance, and once that allowance is used up, it goes down to 50%. So if you're already on 50%, like we've got land and buildings used by our plant and machinery used on our farm that we own personally, that doesn't come into the million, that's separate. We only look at the 100% qualifying assets. So that is the main area of contention at the moment. So it follows, because we often have, say, controlling interests in farming companies or shares in farming partnerships, that not only might we qualify for agricultural property relief, but we might also qualify for business property relief, which is why the two have been amalgamated together for this 1 million allowance. If they both apply, then we look at the agricultural property relief first, with business property relief being available then on any balance. When we're looking at replacement property, it's really important that the whole of the consideration or the proceeds from the first asset are applied in purchasing the replacement asset for the purposes of this relief. The strict reading of the provisions means that if we spend even £1 less, then there's no BPR or APR available anymore. So when we do replacement property for, say, capital gains tax purposes, and we don't fully reinvest the proceeds, we just have, it's just limited as to the amount that we've held over. But here, if we don't invest all of the proceeds, we effectively lose the ownership period. We don't lose the BPR. It says no BPR or APR is available. What it really means is that we can amalgamate the periods, which, remember, that is something that we can do where we've got replacement property normally. As I said, the big issue, people are like, I've got lots of money, should I buy a business or agricultural property to benefit from BPR, APR? It's a question. You just need to make sure that you have got they've got to run it as it, and it's, I'll let it out if it's agricultural property, but there's a lot longer period. But so you've got to be able to be convinced that they can qualify with the conditions. So going on now to valuing transfers. So all of this is fine. We've got our transfers of value. We're hoping that we can use some of the exemptions. If we can't use the exemptions, we know we're now in a potential where we have to think about IHT. But we talk about the value all the time. I've mentioned it, and the value of a transfer for IHT purposes is based on the loss to the donor. So it's by how much the estate has been reduced rather than the market value of the item transferred. So yeah, it's fine getting a valuation, but actually we're looking at the loss to the donor's estate, and this could be different. So a very basic example here that's used, not very likely in reality, but it illustrates the point. We've got an antique table with 8 chairs, and the value of that set is £10,000. Zach gives 2 chairs to his son. One chair on its own is valued at £300, and the table, however, now with only 6 chairs, is only worth £4,000 as a whole. So the concept of the loss to the donor means that the estate has lost £6,000. They had 10,000, now they've only got 6, so only 4, so they've lost 6. The market value of the 2 chairs is £300 each, is £600. However, our value of our transfer for IHT purposes is the 6,000 rather than the 600. Now, I've deliberately used an antique table, but the reality is that this loss to the donor point is really relevant in the context of shares. So if I've got a 75% share interest and I give away 10%, I've gone from having an interest that can effectively do anything, pass special resolutions, change the articles, etc., to one that can't. So I might have given away 10% of my shares, but I've given away a very valuable 10%. So we would look at the value of a 75% interest and a value of a 65% interest, and it would be the difference, the loss to the donor, that would actually be the value transferred. So on death, though, we can't really use those principles because it's a transfer of all of our estate. So our loss is a lot. So we actually have to find out what the open market value of the estate is at death. And this is the price at which it might be reasonably expected to fetch if it was sold on an arm's length basis. We've got 2 things that we don't consider. We don't take any reduction for the fact that the entire estate is being placed onto the market at the same time, which can obviously reduce its value. We ignore that reduction, and any costs that we incurred on making that sale are not taken into account. So we don't say, oh, it would cost us this much to get in a position where we could sell it. That's ignored. Now, there are specific rules such as listed shares, unit trust, life assurance policies, and property held as tenant in common. They're all things that I'm not going to go through. I just flag them up as having their specific valuation rules. One thing around the tenants in common, if you have all property as tenants in common, you each hold a distinct share, and you are allowed a deduction to reflect the fact that you have in its value, to reflect the fact that you can't really sell a half share. So if I've got 2 siblings who own 50% each of a property, and one of them dies, when we're valuing it, we wouldn't just say it was 50%. We'd take off a small amount to reflect the fact that the other sibling can't really sell one without the other. One half, not many people want to buy a half interest in a house as a tenant in common. Where you're passing it to your spouse and it's all exempt anyway, you don't particularly you wouldn't necessarily take that deduction because you're not in a similar, you've not got a problem really with the fact that it's owned by separate people. If we've got overseas assets, we have to convert them to sterling for the purposes of our valuation, and we do use whatever rate gives us the lowest valuation as long as it's reasonable. We can't look and say, oh, 5 years ago this was the rate, we'll have that one. But obviously, it's as long as you can justify it, then you can use the whatever rate you like and the one that gives you the lowest valuation. So thinking about so in addition to that loss to the donor principle, there's 2 very specific rules that we have to consider which might alter our valuation. The first one is related property. So if it gives a higher value, we include our property owned by our spouse or civil partner, or any charities or political parties which received the property via an exempt transfer in the preceding 5 years. So this is where we think, if I have 30% and my spouse has 30%, or I give them, then we will each have 30%. That's worth less than a majority holding or a controlling interest, which between us we have 60%. In those circumstances, we would look at 50% of, or half of, a 60% interest rather than a 30% interest if it gave a higher value. And the charities or political parties is really this, where we set up a charity and we give enough to the charity to reduce our our 50% to 45, and if we've done it within the preceding 5 years, then we'll add that in as well, so that we just do, so we can't get around it. So that is our related property rules. Associated operations is effectively of anti-avoidance legislation, which says, you know what, if we've done a linked or series of transactions whereby that affects the same assets, and that actually gives us a higher value than our chargeable transfer that we're just looking at, then we will use that higher value. And that chain of linked operations doesn't have to take place at the same time. It doesn't have to be made by the same person. So the example that I'm using, which illustrates this point, I think probably again is something, if you were advised, you wouldn't do, but is an example of associated operations in work, is that Jax wants to give a gift into his trust for his grandchildren. That's going to be a chargeable lifetime transfer. It has no nil rate band left. And he gives his wife, Jay, £300,000 on the condition that she makes the gift for him. 2 days later, Jay, who's never made any transfers before, sets up a discretionary trust for the grandchildren for £300,000. It's a bit obvious, but really the gift from Jax to Jay is an exempt spousal transfer. Jay's transfer to the trust would be a chargeable lifetime transfer, but as she's got no previous transfers, 2 annual exemptions available and a full nil rate band, there's going to be no IHT to pay. Now, if Jax had done it himself, he would have had a chargeable lifetime transfer. As no nil rate band, it would have been 20%, so half the tax rates. And we'll come on to the calculation later on. But here, the associated operations rule would kick in, because with 2 operations, the same properties involved, neither really are genuine transfers of value, and the overall effect on Jax's estate is therefore the value that we would use. So he has made Jax would be treated as making a chargeable lifetime transfer of £300,000. So we need to always bear this in the back of our minds when we're doing these sort of like, we'll move it here, then we'll move it there, and then this can happen, because we could be caught by this rule. Okay, so I said really right at the very beginning, the title of this session is doing the IHT calculation. And this is really what I want to get on now. Up to now, albeit we've taken quite a lot of time, we've got a lot of questions, it's all been about sort of the building blocks. What is our property? What are our rules? What are for valuation? Who is chargeable? What is the what property can we exclude, what exemptions are available. But fundamentally, we need to be able to say at the end of the day, is there an IHT liability or not? And as I've said, I've referred already to chargeable lifetime transfers. There's very few. So during our lifetime, will only be a chargeable lifetime transfer if it is a transfer of value made into a trust, a discretionary trust, or an interest in possession trust specifically. Where we do that, that is chargeable at the point we make or settle property on the trust, and it is potentially subject to inheritance tax at half rates. So 20% subject to our availability of our exemptions and reliefs and our nil rate band. there's then this potential charge if we die within 7 years of making the transfer. So all we would do is look back at it and we would see to charge it at full rates and effectively give credit for any tax that's been paid. So our process when we've got a chargeable lifetime transfer, remembering our accumulation principle, is first of all we value it using our loss in the lifetime. We deduct any applicable exemptions and reliefs. So is it business property relief? Or could we use the annual exemption? We then deduct any available nil rate band, remembering that we reduce that by any gross chargeable transfers in the prior 7 years. So gross chargeable transfers are effectively our transfers that we'll have a look at the calculation and I'll look at the specific definition, but that's after the exemptions and reliefs. And any excess is then going to be taxed at 20% if the transferee pays the tax. So I'm making this transfer into a trust and the trust is going to pay the tax. It would be 20%. If the transferor is going to pay the tax, then we effectively have to gross it up. So we would charge it and we would use 20/80 in our calculation. If we have the where we pay the tax, that will increase our gross chargeable transfer. So in the future, when we're looking at gross chargeable transfers in the preceding 7 years, then where we've paid the tax, we need to add it to our the rest of our value. So our pro forma, I've included that in the slides there, and that is shows the formula that we do. So we have our transfer value, we take off our annual exemptions too, if the prior year one is available. We look at our nil rate band that's applicable at the time. I expect that to be 325,000 because it hasn't changed for a while. We take off our gross chargeable transfers in the preceding 7 years, and the excess is either taxed at 20% or 20/80. Our gross chargeable transfer is our effectively our value at A, which is our value less our exemptions. There might be other reliefs that we would have built in to get our transfer value. If the transferor pays the tax, then we would add that in. Okay, so an example there is that we have Mason transfers a buy-to-let property valued at 520,000 to a discretionary trust for his children. He decides he's going to pay the tax on the transfer himself, and he hasn't made any other lifetime transfers, which, as you see, it's easy for me to put in the example so that I can say, oh yes, he's got a full nil rate band, but in real life you would need to work that out and calculate that and see if that is actually true. So we have our transfer value in. There's no other exemptions or reliefs other than the annual exemptions, so we take those off, and we can see with the full nil rate band is available, we still have this excess of 189,000. So, I think one of the questions was what happens if, in the example I did of chargeable lifetime transfers, it exceeded the available nil rate band. Here we can see it does here in this example, because the transferor is paying the tax, it's going to be taxed at 20/80, giving us IHT immediately payable of 47,250. So our overall gross chargeable transfer, which is the value we take forward, is 561,250. Okay, as I say, relatively low. The vast majority of transfers that we do during our lifetime are potentially exempt transfers. And this is where this is a transfer of value that is made by an individual to an individual. Trusts in very limited circumstances, typically where they are not discretionary trusts or where they are not interest in possession trusts. It's where there are very sort of specific trusts for for vulnerable persons, but usually it's individual to an individual. So in our example about that we looked at when we were looking at the exemptions, the gift of the diamond or sapphire ring to a daughter, that would be a pet. The estate here of transferee needs to increase with the value of the property. Because you've either got, so it could be a gift, but equally it could be a transfer if they've just like written a loan off. So, if my child owes me £20,000 for some bizarre reason, they're going to be paying me it back, and I say, don't bother paying me, that is a potentially exempt transfer. And it will be the value that is written off. So we have this so we've got this pet. It's totally ignored whilst the transferor is alive. So the only thing we will do is it will use up our annual exemptions. But on the whole, if it's not otherwise covered by exemptions and reliefs, but there are no other sort of immediate tax consequences of it. The problem comes is if we die within 7 years of the transfer being made, because then we have to look back at it and it becomes chargeable, which is why it's a potentially exempt transfer rather than an exempt transfer. Now, when they die, that means we've got 3 things we've to think about. So we've got our chargeable lifetime transfers. That's all we bother about during the time whilst people are alive. We've got potentially exempt transfers which use up our annual exemptions, but other than that we ignore them. But so when we die, we've got 3 things we have to think about. The first one is this: have we made any pets within the 7 years before death which are now chargeable? A second thing is, have we had any lifetime chargeable transfers which have been made within the 7 years preceding death because they are now chargeable at full rates? And then we've got this deemed transfer of the entire estate immediately prior to death. So whenever we have a death and we're looking at that, we're looking for those 3 things. When we do the IHT calculation, we need to deal with the transfers in strict chronological order, starting with the earliest first. So the death estate will be the last thing we do. So we go back and we would look at we will look at the whole thing. We'll come on to the pro forma shortly, but just a little bit about this death estate transfer. So it's of the estate immediately prior to death. So it's all the assets to which we were beneficially entitled to at their death or acquired by reason of death, less our debts and funeral expenses. Remembering that if they are excluded property, like a residual interest in an estate, or it's a qualifying interest in possession, so it's actually within the relevant property regime, then it's not going to be part of our estate anyway. So all those things are around the excluded property. Now, our tax rate is going to be 40%, but we can get this reduced rate of 36% if our conditions relating to charitable giving apply, and that might be useful for us. So I want to look at the conditions for that. And this tax is paid by the personal representatives on the death estate. We'll see on chargeable lifetime transfers and pets that have become chargeable by virtue of death that the liability rests with the transferees, but here it will be paid by personal representatives. In real terms, it's coming out of the estate, so it is impacting on the beneficiaries, but technically it's the personal representatives who deal with it. Now, we've got our nil rate bans, our spousal exemption, our charitable and political parties, and BPR and APR are still relevant when we assess IHT on the death estate. In addition, we've got some specific reliefs that are only applicable on death, so quick succession relief and fall in value relief. Obviously, we don't have the annual exemption on the death estate. So our IHT calculation for the whole thing, when we are doing it's a bit of a busy slide, that, so we will break it down, but is to first of all work out all our values. So we look at all our lifetime transfers, we categorize them as pets, chargeable lifetime transfers, or exempt, and we know when they were made. We then work through the transfers in a chronological order, calculating the value of those transfers and deducting our annual and other exemptions as appropriate. So we need a view, and you would say, well, you only look back 7 years, but you don't, because say your first transfer that you are looking at is 5 years ago. when you look at that one that was made 5 years ago, you look at the 7 years before that to see whether there were any use of, what nil rate band and things we've got looking at. We don't recalculate on death within 7 years. Sorry, when we live for 7 years or more, but we might need ones that were longer than 7 years before death to work out what the tax is on each of those lifetime or failed pets. So we've got these, so we look at we do the values, we see what we've got. It's usually a big spreadsheet. We then go back to 7 years before death, and we work through and calculate the IHT on all those lifetime transfers that took place at that point. We work through them chronologically, doing the oldest first, and then on each transfer we reduce as I said, the nil rate band available by the gross chargeable transfers in 7 years prior to that transfer. We consider falling relief value, falling value relief. So if we have actually, I'll come on to that, but fundamentally, it's like if we've given something away and it's now fallen in value, we can use the reduced value to recalculate the tax on these lifetime transfers. So we're not at a disadvantage. Any excess that we've got is taxed at 40%, and by excess I mean over the available nil rate band. If we have survived, or the transfer survived for 3 years or more, then we can taper the amount of tax that's is due down on a sliding scale. So we'll look at the percentages shortly, and we deduct any lifetime tax that has been paid where we have a lifetime chargeable transfer. Obviously, if it's a pet, we wouldn't have paid any because we've ignored it until now. We then finally calculate, once we've done all that, we calculate our IHT due on our death estate. We calculate our chargeable estate, which we're going to look at valuation shortly. We deduct any remaining nil rate band. Again, might be all gone with these sort of pets and CLTs, but we don't know. We think about the residence nil rate band at this point, and then we're going to tax at 40 or 36%. We can also think about quick succession relief. This is where somebody has acquired something on the death of someone and then they die themselves within 5 years. That would be we can reduce the IHT that is payable. So the fall in value relief and the quick succession relief are both things that are only available on death, but can be useful to prevent overpayment of IHT. Okay, so looking at each of those, so our additional tax on death for chargeable lifetime transfers, very similar to what we've had, only just a couple of extra lines. So we would take in our fall in value relief, if it's applicable, from our gross chargeable transfer, and this time we would also increase our nil rate band here with any transferred nil rate band from the predeceased spouse or civil partner. If we've got that note that we're not looking at the residence nil rate band, that's only on the death transfer. We have the excess then is taxed at 40%. We can take off taper relief and we take off the lifetime tax that is already paid. For pets, this is the first time they've become chargeable, so we will take off our annual exemptions if they are available and have not been used up. Falling value relief is also applicable. We might have an enhanced nil rate band, but that might be reduced by any chargeable transfers in the preceding 7 years. Our excess, again, we can have taper relief here, but we've not paid any tax previously, so we've no credit. I'm going to do just one big calculation rather than run through all these. Now, taper relief, as I've said, this reduces the calculated IHT on death by a set percentage. So this taper relief is available where we've got pets that have failed or chargeable lifetime transfers that within 7 years of death. But if we live, it's quite useful because say we live for 3 years, our IHT is reduced by 20%. That's better than keeping it and it not being reduced at all. So even if you think, I'm not sure this client's going to live for 7 years, who knows? You don't know what is round the corner. If they live for 3, there's still an IHT benefit to giving funds away earlier. And that is and I say it's right up to sort of the 6 years is 80%. So our example here, just to help us out, we've got Mercia dies in July 2025. She's made a couple of gifts before her death. A painting was 70,000 in 2021, and in 2024 a buy-to-let property to her daughter that's worth 300,000. Because she's died, we look at the gifts that have been made within 7 years of the date of death, so we have to look at both of those. They were pets, so we ignored them at the time, and we look at the initial transfer value. When we look at the initial transfer value, we take off any relevant exemptions. The only one that's relevant here is the marriage exemption on the gift to her son, capped out at £5,000. We can also make use of the annual exemptions. The way that it's worked is they've both effectively get 6,000 of annual exemptions, giving us a chargeable transfer in 2021 of 59,000. So we deal with that first. So I do my valuations, I get my list, I've got my dates, I've got 2 chargeable transfers, one of 59,000 in 2021 and one of 294,000 in 24-25. I'm going to have a death estate in 25-26 as well. So I go through them in strict chronological order. So that would be the first pet would be the painting, and these falling value reliefs not relevant here. Presumably stayed, could have increased in value, but we look at that. The full nil rate band is available at that point. We've no details to say. It's irrelevant about transferred nil rate bands on our example, but might not be on yours. And she's got no gross chargeable transfers in the preceding 7 years. So here, this is totally covered by the nil rate band. So tax payable is nil. The son won't have anything to pay in respect of that painting. But we then come on to pet 2, and the gross chargeable transfer we've worked out is 294,000. This time our nil rate band is reduced by any gross chargeable transfers that have been made in the preceding 7 years of the date of that transfer. So the date of the transfer to the daughter. So that would include the gift to the son. So we have to reduce the nil rate band by that amount. So there's only 266,000 nil rate band left. So we have a little bit of an excess of 28,000. That is taxed at 40%. Taper relief we think about, but it's not relevant here because the gift to the daughter was within 3 years of the date of death. So a tax payable there is 11,200. That would be payable by the daughter. Falling value relief I've mentioned, but just say it's about market value of an asset falling between the date of the transfer and the date it's either sold or its market value at death. Remember, if a pet or a chargeable lifetime transfer becomes chargeable, it just because somebody's died within 7 years of the date of death, it's still chargeable even if the transferee no longer has the asset. So if all it does is say, well, we actually allow the loss of value or the lower value to be used to calculate the IHT. The only thing that's really that you should be aware is you do have to claim it by the transferee. So within 4 years of the date of death of the transferor, remember it's a transferee liability. They have to make the claim, and it's meant to compare like with like. So we don't really think about loss to the donor here, and we don't think of changes to value that are not linked to the market value. So say, for example, I I'm gifted a buy-to-let property and I build a, let's say I build a swimming pool in it, and it becomes, therefore reduces the market value because they tend to reduce rather than increase, that wouldn't be a fall in value relief. What would be fall in value relief is that you, at the time it was transferred, it was worth 300,000, but due to market conditions, it's now only worth 280,000. And we could show that we would then use 280,000 as the value. Where we have gifts with a reservation of benefit, I've referred to these already. It's where we give something away, but we keep it ourselves. So I give someone a painting, but keep it left in my study. Or I give somebody a house, but I go and stay in it I give them a holiday home. It's very typical, but I use it myself. That is still, I've not really given that away. The property will be treated as forming part of the transferor's estate at death. There's a few, and at the point when we stop using it, then a pet's made on that day. So at the point I say, that painting's yours, and then when I redecorate my study, I actually give it to my son. That's the point when I've made the pet. Before that, it stays in my estate. We do have a big problem with things like holiday homes. There are exemptions if the use is minimal. So HMRC typically take 10% as the starting point. We might be okay. If we say give someone a house and we come back and we stay for and we go and visit them for Christmas, that won't be a reservation of benefit. But if we give them a holiday home and it's split like 50-50 during the year, then that is a reservation of benefit. So we can get round it by paying full consideration for the use of the property. So we could do that, like rent the holiday home when we've given it away to our son, remembering that obviously any payments that we make, it's no gratuitous intent, so it's not an IHT issue, but it would be income in the hands of the recipient. So we might have an income tax issue. So yeah, it's like out of one tax frying pan and into the other. But full consideration we can have. We can also have if we have to move back into our house, it's our house that we've given away, and we have to move back in because we become ill. That isn't regarded as a gift with a reservation of benefit as long as we didn't know about it at the date of transfer. So things to think about. There are the pre-owned asset rules as well. We can elect to pay income tax on the value of the benefit, which would also take us out of this rules. So again, giving away without giving away is a potential cause for concern. So debts and expenses, is we can take them off. I know we've got lots of questions. Just let me check on that because I've got them all seem super specific. Okay, so I'm going to work through these at the end. I'm just seeing they're all very specific client type questions. And Caroline, I've noted your point about pay. When do we pay it? Then I will. I know that you can't all see the questions that are put in the Q&A, so I'll come back to them and I'll work through them when we've, to the extent we've got sort of time at the end. So remember I said that debts and expenses are deductible. So anything that we've incurred for full consideration, so like a genuine debt, can be deducted. Any taxes that are unpaid, so our income tax, our capital gains tax comes off, and our reasonable funeral expenses. HMRC don't really look at reasonable. They don't like start talking about whether you should have had this expensive coffin or could you really have afforded all those flowers. That isn't what they mean by reasonable. It's just if you get to, if you say, my grandma really loved travel, so we're going to use all of us estate to so the family can travel all around the world in her honour for the next year. That would not be a reasonable funeral expense, carrying her ashes with us. So it just is what you would normally expect. But on the whole, you don't have to quibble over specifics. Okay. Gambling debts and bizarrely, endowment mortgages, if anybody has one, are excluded. So you can't deduct any gambling debts. If a debt's charged on a specific property, like a mortgage on a house, then the debt is deductible primarily from the property on which it is charged. This becomes really relevant in the context of, say, business property, because if I've got a charge, I'm a sole practitioner, I've got maybe I've got a share in a partnership, maybe I've got some debt charged on a specific property, maybe I've bought an office and I'm renting it to my partnership, so I'm expecting to get BPR at 50%. The mortgage on that property will be deducted from that property, so it will reduce the yes, it reduces the value of the estate overall, but it also reduces the value of the that particular asset, and so the availability of relief. So again, with spouses, if it's a mortgage on a house, you don't say transfer the house and look at the value of the house. It's going to be without the mortgage, it is the value with the mortgage. So yeah, there's lots of forestalling around that with the to make sure that that's not abused. Okay. Oops. So looking then at the death estate sort of pro forma, fairly chunky, but I've laid it all out for you on one slide. We look at our chargeable assets owned at death. We take off our debts, unpaid taxes and expenses. We take off our exemptions. Remember, they are quite limited. We look at our death transfer specific exemptions are going to be our quick our death transfer specific exemptions. Remember, I talked about those being certain payments coming out of World War II, and or if we have death in service of emergency service personnel. That gives us our chargeable estate. This time we've got our nil rate bands that we've got to think about, and that would include we might have an extra residence nil rate band to put in, and we would take off our quick succession relief. We've also got to think about double tax relief to give us the amount, and again I'll come on to what that means. So quick succession relief, we haven't seen that before. That's, as I've said, is where the recipient of a chargeable transfer dies within 5 years of the acquisition. It's given as a form of tax credit against the IHT liability. So we give it right down here on this, the third line from the bottom. So it's a credit against the tax rather than a reduction in the value of the shares. Of the estate itself. It's a proportion of the tax that is attributable to the first transfer. So we effectively have to look at the first transfer and the first death, and we look at the value of the net gift that the beneficiary has received as a proportion of that gross chargeable transfer on the first estate. And then we look at that and we see, if it represented 50% of the estate, then it's going to be 50% of the gives us a proportion. We then apply a percentage to that, which is from 20% to 100%, depending on the amount of time between the first and the second transfer. With that 100% if you've died within a year, down to 20% if it's within 5 years. You don't have to still own the asset at the recipient's death to get this relief. Okay, now it's fairly complex is that, but I'm going to leave it because it's very specific circumstances. Just bear that in mind. If you see 2 deaths in succession, it can be very valuable, particularly if the recipient's primary wealth is that it has been acquired on that first death. I think what is very interesting in terms of planning is this charitable rate, because it can be quite valuable. If a sufficient proportion is gifted to our UK charities or community amateur sports club, then we get a lower rate of inheritance tax on the whole estate. The amount that we have to have donated to charity, though, is at least 10% of our baseline estate. Which is the amount that's chargeable to IHT before the donation to charity has been deducted. So it actually isn't 10% of our whole estate, it's 10% of the amount that's chargeable before our deduction, which means we've taken into account our baseline estate. We will have taken in our exemptions, our general nil rate band, any other reliefs that we've got before we apply that percentage. We do not, however, reduce it by the residence nil rate band. So let's do a calculation, then we'll have another quick break. And then we'll wrap up with some sort of key other points, relevant property regime, and all your questions. So we've got Aki, who dies in May 2025. He's not made any previous chargeable transfers, few, so we don't have to, if he had, we'd have to go back and recalculate those. His estate is 1.4 million. He's got some property that's eligible for 50% business property relief. That property is being valued at £60,000. He's got some funeral expenses, some unpaid tax, and some gambling debts. He's left 400,000 share of his main residence to his wife, with a further 200,000 to her, 95,000 to charity, and the balance of his estate to his twin sister. And on the face of it, you think, well, he's got 1.4 million. He's only given 95%, first 95,000 to Bernardo's. So it looks like it's going to be 40%. But when we look at the baseline calculation here, we can see that his baseline estate is actually 440,000. And he's given 95,000 away. So he actually, in this calculation, his IHT rate would be 36%. And in fact, it would have been 36% if he'd have just given 44,000 away. So it is something worth looking at. Using the pro forma then, I don't think I need to go through that in detail because we've discussed it, but we can see that his tax here, to the extent that it's over the nil rate band, is the entire estate, not just the charity donation, is taxed at 36%. And also the charity donation itself is an exemption. So we've got not only do we save for the 95,000 we've given to Bernardo's, but we get this 36% on the rest of the chargeable estate, which would be, which is worth the saving. I mean, you could crunch the numbers. You might think, oh, we were better keeping 95,000 and paying 40% on everything, but it all depends on the proportions and the value. Okay, so payment and administration. I'm going to just do this first because it just helps us with, it's one slide, I think. And so who is responsible? Well, we've said on a CLT, the lifetime IHT is typically the transferor who has to pay it. Whether it's coming out of the gift that they make or whether they do it out of their own funds does affect the percentage, but it's the transferor who has the responsibility if they are paying the. So we do that 12 months after the end of the month in which the gift is made. That's our filing, and our payment dates are there. On death, for both a pet and a CLT, it's the transferee that is liable, but we actually include it usually in the IHT 400, which is the big form that we send in as the personal representative. So we do the filing as the personal representatives, that's the way HMRC have the information, but it's the transferees who make the payment, which is literally typically 6 months after the end of the month in which the death occurred. Similarly with gifts with reservation of benefits, it is the owner, so the person we've transferred it to. So even though it's included in our estate for IHT purposes, it's going to be the person we gave it to who makes the payment. But again, we put it in our IHT 400, and then our personal representatives are going to be doing the filing of the death estate, any other information that we need, and we have to pay that on the delivery of the IHT account. It's quite tricky because we often can't deal with the estate until we've discharged the IHT. we are allowed to take out sort of loans. We might be able to pay by installments as well. I'm just leaving that there in the interests of time, because we can read that there's no real value add there. I'm going to take a 10-minute break, and then we're going to talk about some chunky stuff for the last half hour or so. All right. So yeah, 25 past 11, and we'll start again. And I'll have a look at some of your questions, your many questions. I've been chipping away at your questions if I've not answered them. Sorry, I'll carry on as we go. Just really quite cantered through quite a lot of sort of the calculation, the way we go about looking at things, the way we go about valuing things. I want to spend the last part of the session thinking about other charges. A couple of people have sent pre-questions about relevant property trusts. It is something we do have to think about as advisors, but then also want to talk about sort of some tax planning thoughts and again, sort of like the future. So starting with the relevant property trusts. What do we mean by this? Well, some trusts hold property which does not form part of the estate of anyone. So typically these would be, say, a discretionary trust where the trustees will hold a fund, which is for an all class of beneficiaries, being sort of for such amounts or for whoever they choose. So we can't say that being a beneficiary in a discretionary trust actually must be part of your estate, because you might get nothing. So that's not in the estate. And also we have specifically excluded from the definition of estate a non-qualifying interest in possession, which, remember, are most interests in possession that were formed in after I'm going to say 1996. I think the dates eluded me there. So most modern interests in possession are not forming part of the estate of anyone. But where we hold that property that doesn't form part of the estate of anybody else, but we have it in the trust, and it's with it, and the settlor typically is a long-term UK resident, then it's subject to the relevant property regime. So right at the beginning, I said, oh, just because it's not in the estate and it's on a trust doesn't mean it's not subject to IHT. It'll be within this relevant property regime. So typically discretionary trusts and trusts with non-qualifying interest in possession are something that we need to think about the relevant property regime. And there are 3 points of charge. Now, the first one is the chargeable lifetime transfer, which we've already discussed. This is when we transfer property into our trust. It's going to be at half lifetime rates, 20%, if it exceeds the available nil rate band. And of course, it's going to be looking at the 7 years before the trust was created in terms of whether we've got any available national nil rate band left. We then have 2 charges that apply, disconnected with any deaths or anything like that. Every 10-year anniversary of the trust creation, we will have what is called the principal charge. In my day, we used to refer to it as the periodic charge, but it's in the legislation, it's principal charge. And that will be 6% of the value of the assets in the trust, less any available nil rate band. And it is, in terms of the nil rate band here, is going to be reduced by any gross chargeable transfers in the 7 years before the trust was created, and any exits of relevant property in those previous 10 years in relation to that trust. So we might not have, our nil rate band might not be available. Exit charge, more likely, so that's every 10 years. Within that 10 years or after, between all those charges, it's only 6%. The idea is that everything in the trust will be charged once over your over the lifetime of the trust. That's the idea of it. When assets pass out of the trust to a beneficiary, then we have an exit charge, and that is 6% times n over 40, where n is like the number of calendar quarters since the last principal charge, or if there hasn't been one, the creation of the trust, multiply by the net assets leaving the trust less the available national nil rate band. But again, the nil rate band is reduced by gross chargeable transfers in the 7 years before the trust was created. So effectively, that stops us from putting something into a trust and then effectively getting a sneaky extra nil rate band. It's like so when they pass it on. So remember that that's how that would work. So just not free of inheritance tax really at all. But really, they're just in terms of that very sort of specific rules. It makes the discretionary trusts and non-qualifying interest in possession trust less attractive. But talking about inheritance tax and tax planning at its most basic level, one of the things that you have is that most people, if you give everything away, most transfers will be potentially exempt transfers. So if we live until for 7 years, we're outside of the inheritance tax net altogether. And that's really attractive for inheritance tax. And if that's all we had to think about, we'd be just like give everything away. But we've got to think about capital gains tax, because capital gains tax, lifetime transfers for inheritance tax purposes, are also disposals for capital gains tax purposes. And these are often deemed to be at market value. So I might give my, I've got a holiday home, I give it to my daughter. Great, I'm in good health, that's a pet, it'll live for 7 years, it's outside of my estate, I don't need it. If I don't use it, I've not got a gift with a reservation of benefit. If I do use it, I could pay her. And she might be taxed on that, but we don't know. She might be relatively low income. But I'll be deemed to have given that property away for capital gains tax purposes, and it will be deemed to be given away at market value. Therefore, to the extent that it stands at a gain, I'm going to be paying in capital gains tax. So this can create a direct conflict, well, does create a direct conflict between reducing our estate for IHT purposes and actually minimising capital gains tax. So we would pay, but the one thing to note is that if we do capital gains tax, it's my responsibility as the transferor, whereas it's the recipient who would typically pay the inheritance tax. So we've got to balance those up. Remember, we could have gift relief for capital gains tax. So if it is a gift of business property, or if it is a gift where we are immediately chargeable to inheritance tax, so a chargeable lifetime transfer, then we can claim gift relief, and we effectively hold over the gain and reduce the recipient's base cost. So we don't pay it on the transfer, but ultimately, when the recipient disposes of the asset, then there will be a capital gains tax on a greater gain than there otherwise would be. So when we do that, we can treat any inheritance tax that we pay as part of our acquisition cost when we calculate our capital gain on the ultimate disposal. So we might think about that. But there's other things to think about. So I've just done this comparison between lifetime and death gifts. So if I've got an asset, I've got to decide, do I give it away now while I'm living, or do I give it away and leave it to my death estate? Now, if I do a lifetime transfer, they said I can use my lifetime exemptions. Taper relief kicks in if I live for more than 3 years. And if I survive for 7 years, then and it's a pet, I won't have it, or even if I've got a chargeable lifetime transfer, there's no actual IHT on death in respect of those lifetime gifts. My transfer value is set at the date of the transfer. So if it's increasing in value, I'm best giving it away sooner rather than later. to protect against the other going the other way, I would have fall in value relief if it fell in value. But I have this CGT liability. Remember, though, cash is not chargeable for capital gains tax purposes. And we also have some capital gains tax exemptions. Our annual exemption is not worth a lot, £3,000. But we also have the holdover relief. So we've got to think about the CGT. Our transfers on death, though, we get this CGT uplift for the time being. So if we keep our asset till death, our beneficiaries receive it at the market value at the date of death. That can be super valuable. So because if I've got something that I've bought at a low price, it's massively increased in value. I give it in death, they get that effective growth free of capital gains tax. I can use my residence nil rate band, which I can't use in lifetime transfers. So I get a little bit of an extra there. Whether it's relevant or not will depend on my circumstances. And of course, if I've got more chance of reaching my 2 and 7 year qualifying ownership periods for BPR and APR, and I can control what people do in terms of the actual business, because if I give my business away now and the people I give it to decide not to bother with running it as a business, then that effectively I would lose the BPR. I mean, it's not my problem, it's theirs, because they're the ones who stopped using it as a business and they're the ones that pay the tax, but that's not really what the planning is all about. So the other thing that we would use typically, let me just talk a little bit more about these lifetime and death gifts though. So what we tend to do is we tend to keep business assets and things that have this business property relief and agricultural property relief. We tend to keep them in the estate because they're going to increase in value. It's 100% in some respects, and we've got this better chance of keeping that qualifying. And if things stand at a huge gain, we tend to keep them in the estate for capital gains tax purposes. If they're not at a gain, then we should really think about giving them out sooner rather than later, always subject to the point that we need the funds to live on. So again, it's that combination of those that we need to apply to every sort of asset that our client has. So the variations then, essentially within 2 years of death, we can change with the agreement of all the beneficiaries or the relevant beneficiaries. The PRs can agree that they are going to change the disposition under the will. So we could leave more to charity to trigger a 36% rate. We might skip a generation to make sure we can use our nil rate bands. We might change it so we leave our main residence to a direct descendant to trigger the residence NRB. So if just because we've done bad will planning, if the beneficiaries agree, then we could have a variation like, don't leave this to me, leave it to that person. I mean, it's easier said than done, and chances are in practice, beneficiaries won't agree, so we don't need you we can't rely on it instead of proactive planning, but it is there if we need to do it. And if we do a variation, we pretend that the variation was what was left on the was the disposition of the estate instead of in accordance with the original will. So there's no tax consequences of a variation in itself. Okay, so where does that leave us then with future changes? I've already referred to what the main one is. Well, we've got nil rate bands and taper thresholds are frozen until at least 2930. That's not useful, but it does know we know we're dealing with it. The big one is as we said, this APR and BPR that's capped at 1 million of the combined value of eligible agricultural and business assets. The remaining value is subject to 50% relief. So I've heard HMRC say, well, this is only going to affect businesses that are worth more than 2 million. Again, they're looking at the 1 million allowance and the million given by all the combination of nil rate bands or anything, and the fact that you still get 50% relief if you've got 2 million. or even 2.2, wouldn't it? It would be, but it it's not real. So for many people, this is like a big deal. They thought that they were getting 100% business property relief. They've left it in their estate. They're leaving it in their estate so they can get the capital gains tax uplift and not pay any inheritance tax. And all of a sudden, they're looking at paying potential inheritance tax. Okay, so we've got this million. Somebody asked a question about doing a calculation. The rules are actually available yet, but the consultation has finished. We should be seeing the outcome and the draft rules fairly soon. Who knows? They've promised them soon, but I think I've seen that before. So we would have, but as I understand it at the moment, it is a £1 million allowance that when we look at a chargeable event, we look at the agricultural property and the business property relief that is in that estate or at that event, chargeable event at that point, and we see if it would have qualified for 100% relief, it gets it. But when we combine it, if we look back within 7 years and we look at all the other times that we've claimed 100% relief, taken with this particular value, that is capped at £1 million. The excess is therefore at 50%. So 50% assets value, that just continues. That does not come into the 1 million allowance. If we 7 years pass, it's the same cumulative principle. So we might be therefore thinking about passing out more of our estate to make the use of this cumulative allowance. Obviously, we've got to think about capital gains tax in that respect, but it is business. It could qualify. Well, if it qualifies for 100% relief for business property relief, it's going to qualify for 100%. It's going to qualify for holdover relief. So that might be a circumstance where we hold it over. But you've got to remember, you're then passing on the capital gains tax liability to whoever you're giving it away. At the moment, capital gains tax is less than inheritance tax, but obviously you've got your nil rate ban. So that's the things that are sort of thinking about. Aim listed is just bearing in mind that it is 50%, not 100%. I mean, to some extent, you might have thought that it should have been 50% in the first place, but it's something to think about. The pension schemes, though, are as a question has been asked on that. This is still 6th of April 2027. So if somebody dies before that, it's outside their estate. Remember, it always was included, or as for the last few years, always been included in the estate if you die and you are 75 years or over. So it's just this gap now between where somebody dies before they are 75. It will be included in the estate. It is usually, however, cash. So if you were to draw it down, at least the tax-free amount, you could pass that over without capital gains tax consequences. If you withdraw it in cash beyond the tax-free 25%, then clearly it's subject to income tax. So you would have to crunch the numbers. But there's no capital gains tax consequences there. This is all about affordability, I think, and what you kind of live on, and whether you draw them down. And I guess if you've got properties within your pension schemes, then it's not in the form of cash, then you've got the capital gains tax implications to think about there. All right, so we've got to, I don't even ask any questions, but we've got to a position where I'm going to look at the chat first. So I think we've got quite a few on the chat and we've got quite a few, but I think everybody can see them on the chat. No. Yeah, so running down, Sergio, yes, we do have some, there's a question here saying we do have some tax treaties with 5 countries that deal with IHT, which could exclude some property from them. Yeah, so we always have the double tax treaties to consider once we've done the calculation in accordance with the UK. I think I built that in on the death estate. So don't forget to look at those specific countries. One is France, I believe. One is Belgium, but we've not got very many. The problem we've got, or not the problem, but the issue we've got is that they often refer to people who are domiciled or non-domiciled. They don't have the concept of long-term UK residence. So how it will square off will very much depend on the text of those treaties. Let's see what else we've got. That somebody's asked a question about where a bank account's located if they're open on the internet and the bank doesn't have branches. That's a really good question. I actually have no idea. I'm assuming if all the servers and everything are outside of the UK, then it's got to be an overseas account. But to be honest, I'm not super sure on that question. Sorry, Carolina, if you can't be more definitive on it. Yes, when we did that example, it would have been if it's a chargeable lifetime transfer and it exceeds the available nil rate band, whatever that is, then that would be correct. That would give us an immediate charge to liability at half rates. Yeah, I think the definition of children does extend to stepchildren or adopted children. So it's the direct descendant. So I would look at the actual definition in IHT, which does everybody. But yes, definitely adopted children. So, and then so that was just asking if the residence nil rate band was available to adopted children. Have a look. Okay. I'm going to skip over these big sort of specific fact patterns. Probably I'm going to try and do the shorter questions now, more generic points, because some of these fact patterns are quite complex. So yeah, I'm going to say on the shares. So if you've got 30,000 investment, yes, it's on the 70,000 because the goodwill it's in a trading company. So that would be fine. So scrolling down this chat's giving me so we've got a recording. So Joanne said, if you die after 7 years of making a chargeable lifetime transfer and you've paid 20% on the lifetime transfer, it's not recoverable. That's correct, Joanne. You've paid 20%. That's it. If you die within 7 years, you've got to pay 40% and be given credit for the 20%, but you don't get it back. Okay. Yeah, so your solicitor's fees for probates are expenses, but whether they are expenses, yeah. Estate. So I'm struggling with scrolling down on this. Okay. Yeah, so the question, Richard, I think you were asking me as to whether excluded property is counted or not in the £2 million taper limit. It's not. The 2 million is based on the net chargeable estate. So it has to be on the the definition of estate. So you should be okay if you've got a UK resident on that. Okay, I think I've got all the chat box questions. And then I'll just try and pick up some of these Q&A ones, which I appreciate people can't see them. So Jayesh has asked me, if you're converting debt to equity, would the new equity qualify for business property relief per the replacement property rules? Yes, if it was all, if the debt fell within the definition of securities, it would. So the period of ownership for the debt would count if all the other conditions were satisfied, and the new equity would also qualify. You could then amalgamate those two periods of ownership if the equity satisfies the criteria. For property investment company, do you take account of the individual properties valuation of Oh, Paul, that's a valuation question. But yeah, in terms of your value in the company, you would always, if you think about standard valuation methodologies, it would be for property investment net assets. So you have net assets, so you have dividend yield or profit multiples or specific methodologies. And with a property investment company, net assets is quite a way where you can go. And I think for net assets, you kind of do have to think about liabilities. So I guess it's about the likelihood of those liabilities. But yeah, if you could argue that there was a lot of capital gains tax, then you would take that into the value. But my concern would be is that yeah, you might save your IHT, but that value that you've got of the property investment company on death becomes the value of the company for the CGT base cost on the recipient. So it wouldn't be. So it's going to be a question of fact, and we'll want to crunch the numbers on that, and it would depend on the likelihood of the sale as well, because if you weren't going to sell the properties to anybody, I would imagine that the HMRC's valuation wouldn't think that you could take that in as a liability. Yeah. So instead of, I think Caroline, I've answered that question about IHT being payable on pets. That's within 6 months of the end of the month of the date of death of the transferor. And they may be able to get it by installments. One of the things that we can think about with pets, where we think that somebody's not going to survive for 7 years, is insurance. It can be quite expensive, but you can get IHT insurance against people having to pay the tax. Or typically, you might also want to think about leaving something to these individuals in order to pay the pet if the worst happens. But that does require you to be on top of your will plan. It might not be tax efficient in itself, but I've seen people do that and make sure that the individuals who've received assets but are poor on cash also get some cash or some estate on death so that they can discharge the pet. I mean, to be honest, that's why you do it in the IHT 400. Sometimes sometimes the recipient of the pet and the residual beneficiary are one and the same. So technically, so Anil's asked a question about whether a trust would be liable to IHT, and if so, like when? Well, for the estate, it's only for people who are beneficially entitled to the estate. So a trust in itself is not liable for IHT. However, transfers to a trust are, and we would also you have the relevant property regime. So if the trust consists of individuals, so it consists of property that is within the relevant property regime, so it's a discretionary trust or it's got non-qualifying interest in possession, then it will have to pay these periodic charges and the exit charges. So it would be responsible where it had, and if it was overseas, it would still be within that. With if there were properties within the UK. So Hilary asks if foreign pensions due are included in the estate. Well, if you are a long-term resident, a UK resident, yes. If you are a non-long-term or long-term non-UK, how would I say it? Not a long-term UK resident, then no, you should be okay. And that is subject to any tax treaty that you've got. But as I say, they're quite unusual, the tax treaties here. Oh. Yes, so I think Ajay, at the moment, if you die under 75, your pension is not included in your IHT estate. When the new rules come in, and that's the case now, when the new rules come in, it's going to be regardless of when you die. But again, we're still waiting for the draft rules to come out. So. So Oliver's sort of just asked me to clarify whether shares in an unlisted company are subject to the 1 million allowance. So if they, and then 50% for the value above, that's it. So you've got your, if you qualify for 100% at the moment, you will still qualify for 100% up to £1 million allowance when aggregated with all your other uses of the allowance within the preceding 7 years. After that, it goes to 50%. So if you've got, you've already used it all up because you've done a chargeable transfer of over £1 million, then everything that you have would then be 50% until you got out of your 7-year cycle. I'm running out of time. I'm really sorry if I've not picked up your questions. I'll just try and do a couple more. Yeah, so Alan's asked a question about where you've got an asset in an estate, so debt payable by instalments. Can you agree with HMRC that the debt can be deferred until the relevant loan repayment is received? You can agree anything with HMRC. Sometimes they allow you, sometimes they don't, but there will be interest running on it. So unless it's certain property. So whether they say yes, Alan, you can certainly ask, but if whether they say yes or not will depend on whether they believe that it would cause a hardship to require it to be paid in any other way. It's always worth an ask. But you've got the interest rate's quite a lot. It's 2.5% plus base rate. Oh. So Tanya asked a question about giving property away now in order to avoid the APR based on the new 1 million. I can't answer that because of the forestalling rules. It's not really, it's just a little bit beyond sort of the scope today, but there are a number of forestalling rules that prevent you doing things after the 30th of October 2024 to try and get out of the APR 1 million. So I would think that I don't know how it would quite work, but I would think that that giving away things now wouldn't particularly help. Okay, I'm mindful of the time. Very sorry if I haven't got to your questions. Um, so, really sorry about that. We just run out of time. I've seen what I can, but hopefully might be able to do a Q&A session on this at some point. after the rules have been, maybe I should come back and do that and answer specific questions. But thank you very much for your time, and hope you found it useful.